Director at MK Global. Mr. Karwa, great to have you with us here. Thanks very much. Good morning. Have you already seen
Good
the
morning.
worst for the markets, Mr. Karwa, in terms of aggregate index levels? And how do you think the market trades going forward? Just at an aggregate level first before we get into sectors.
So yeah, in the last 1 month, if you see, the indices have gone up by some 8-9%. My sense is that, for almost 6 months, we were very focused on the global macro headwinds. Possibly, they seem to have been totally discounted. And now our markets are also seeing some benign FPI inflows, or rather outflows have stopped for some time. So I think what we are seeing now is our markets are now again back to its normal domestic fundamentals focus based on the results, etc. And maybe the sharp selling sell-off which we saw in June, I think we have recovered from there reasonably well. Now to say whether the worst is behind us, possibly not very difficult to say because global macros can still change. But at least whoever has bought in the sell-off which took place in June, first few weeks of June, they seem to be in the money. So my sense is that this is a market where you buy into pessimism and you sell in optimism.
Okay, the stock of the day right now is Canpin Homes. It's just very close to actually hitting a temporary freeze. 8% higher on that stock. Look at that move, 8.5. Krishna, good morning. Thanks for joining us. We've seen a very sharp recovery in a lot of these sort of banking and financial names. Do you think that could still retain leadership, the overall leadership for the market?
Definitely. I think if you look at the banking and financial sector, the numbers have been coming for the last 3-4 quarters, and the balance sheet strength of most of the banks and is very decent. And now credit growth is also picking up, and we are not even seeing any great new NPAs, etc. So there are all the parameters are there for the sector to do well. But what we had seen in the last 6 months was this relentless FPI selling, which was majorly focused on banking, financials, and IT. So I think now maybe things have improved in terms of FPI selling, and the fundamentals are attractive. Valuations of most of the banks are attractive. So we are seeing the first round of rally. And I think if you look at it from a year-to-date perspective, also the banking index has outperformed the broader index. So there are more legs to this rally. I think what is the challenge in this sector is the over ownership which a few of the large private banks have in terms of the domestic ownership. So the ability of the domestic institutions to invest incremental in these banks is a limitation. So that is something, but I believe if FPIs again become positive on the markets, then they would be the ones who would again drive the financial sector up.
Well, Krishna, just hold on to that thought. As we're talking about the Nifty Bank, it's trading above the 200 DMA now, 20%, 20 points higher. Remember, we needed to start off with a gain of around 220 points odd. So we met that, and now we're trading higher than the 200 DMA. So I think that as well should come up for you. Important technical level out there. And the Nifty now is gradually moving towards the 16,700 odd mark. Well, Krishna, you've given us your view on banking names. Mid-cap IT has made a bit of a comeback. And some of these IT stocks, they've got hit hard. Whether it's a valuation reset or the market is not viewing them positively from year on, how would you view it post this sharp correction we have seen on large cap and mid cap IT?
So if you look at, the fear was obviously in terms of the expected US recession, and will there be any challenges in terms of order inflow or new businesses. Now, so far, whatever comments are coming from various corporates in the IT sector, they don't seem to be seeing any slowdown in their business. And in fact, seem to be on the stronger uptick only. So business-wise, there is no expected headwinds as of today. Now, in terms of attrition and all, possibly in the next coming quarters, we should see a plateauing of attrition also. So those margin pressures from at least wage cost, etc. perspective should come off. Yeah, valuations have been expensive, and that's why we see almost like a 25-30% cut in the IT index. But my sense is that even now the valuations have not yet come off to where you can possibly thump your table and buy into these stocks. What we possibly see is this is an oversold sector as of now. And if you believe that the market trajectory is on a positive, then you will see some rallies which will happen in the large cap as well as in the mid cap IT companies.
Mr. Karwa, where else are you finding sort of good opportunities with good risk rewards? If you have, if one has time on their side and short-term trading areas.
No, I'm not. Yeah. So if you look at amongst the opportunities where we see in consumer discretionary, there could be good opportunities for investors to invest in, whether it is the QSR or whether it's the fashion retail and consumer durable. I think that segment still offers a lot of opportunity. One more segment which we believe the valuations are very reasonable is the whole agrochemical space. If you see, most of the companies are valued very actively in terms of valuations, and both the global and the local opportunity for most of these companies should be decent. As far as input prices now, maybe as your supply chain and as input prices also stabilize, I think this is a segment which should possibly do well.
Okay, the market, by the way, is just not stopping. It's been a stunning move. Like we discussed in the morning setup as well, the Bank Nifty above the 200-day moving average, the Nifty now above that 16,661 mark and negating the losses of May. The mid-cap index has been on a serious run in the last 1 month. The mid-cap is now 6%. So a lot of these stocks doing well. Krishna, one space which has not done too well in this rally is cement. Of course, this is a monsoon period as well. Anecdotally, you see underperformance, but what's your view here? And a couple of other economy-facing sectors as well.
So we have a positive view on the cement sector. My sense is that the high input prices that they were struggling with, and which is reflected in possibly the EBITDA per ton that many of these companies will show in the coming few days. I think that is possibly behind them, and in a quarter, at least they should be normal as far as the input prices are concerned. Now, as far as realizations are concerned, the demand is not a concern, and realizations also should inch up. There was this fear that by takeover of ACC Ambuja by one of the big conglomerates, maybe there could be some additional competitive pressure. But that is, I think, maybe 3-4 years down the line that we should see, if any, extraordinary competitive pressure. So I think the whole space from a medium-term perspective offers opportunity for investors to invest in, be it the mid-market cement companies or the large-cap cement companies. That segment seems to be investors with a slightly longer term perspective should be looking to invest in that segment. Another segment which continues to do well and I believe has still more legs to its rally is the whole automobile and auto ancillary space. No doubt there has been a very decent rally in many of the auto majors, but I think that the input prices pressure that was there possibly will ease off, and even the shortages of chips, etc. So that segment demand is very good, and that should do very well. With that, maybe commercial vehicle segment should give you very good returns, and some of these tractor companies which are now become MNCs, those kind of companies also should be traded. Auto ancillary is obviously a play on the segment again, and there offers a lot of opportunities for investors to invest in.
Okay, auto ancillaries. Krishna, what about the diagnostic space? Every month I think we hear about a new player getting in there. It's getting a little bit competitive. Some of them valuation wise, well, out there. How do you approach this space?
I think in terms of valuations and opportunities, I think possibly the best is behind. They enjoyed very good valuations at the peak of the COVID, and now as you see that it's very competitive space, and you have all the deep-pocketed conglomerates also wanting to get into this business. The space is obviously there's a lot of space for consolidation. There's a lot of unorganized players still there in that business. So the growth opportunity is definitely there. But in terms of investor returns, possibly it could be muted primarily because of the high valuation that these companies are still looking at.
No, got that. Public sector banking space, which was the narrative was that, well, a large amount of cleanup has happened and profitability will improve. SBI, of course, is a case in point where a lot of those things have happened, but there were others as well. I mean, names like Canada, etc. Do you see market conditions overall improve?
Well, definitely, whenever there are tailwinds in the sector, and I believe that the whole banking space, there is very good tailwind in terms of the demand for credit itself and the cleanup which has happened in the whole banking system. Do well, then at least for the next few years, we don't have too many challenges as far as fresh incremental normal NPAs, etc. So there is no reason why even your public sector banks should not benefit from this tailwinds. And valuations of many of these banks have been reasonable. They have also invested in technologies and are at the cutting edge technology as far as business is concerned. Plus, there could be some opportunities where there are talks of maybe privatization of some of these banks. We have already seen some consolidation happening amongst the public sector banks, and now if there is some privatization happening, that could be an upside kicker. So yes, possibly in terms of return ratios, maybe some of these public sector banks may outperform in terms of in the short term versus your known private sector big names.
Okay, well, the market is surging now, almost on the day now, and a lot of stocks are looking up right now. So let's see, Krishna. So, what is the big risk factor now for this? Because we have over decline, and the rise has been equally sharp. From here on, what to your mind is the biggest risk?
I think the biggest challenge, which I believe, is that we have seen the strength of the US dollar versus the developed countries. I mean, whether it was the British pound or whether it's euro or yen. Now, this kind of sharp depreciation in these developed currencies versus the US dollar, I don't think so. We have seen in 1.5, 2 months, 10-15% kind of corrections. Now, what are the implications for the global economies because of the sharp correction in the currencies of these countries, and how does that impact the global economy? I don't think so we have great answers, and how that will impact our businesses and our markets. I think that is something which we need to be very careful about, and this is a one macro which is still not played out. And plus, I think this quantitative tightening has just started in the US. Now, what was a 12-year flow of liquidity into the system, the reverse cannot happen in a quarter or two. So we have no understanding of how this quantitative tightening can impact global liquidities and interest rates and valuations. Now, that is something which we need to worry about. So it's all about not about only about our businesses, but about how we will value these businesses. Could possibly go wrong on the valuation multiples versus not the business itself.
Okay, Krishna, we'll leave it there today. Thanks a lot for joining us. Always good talking to you.